Hey guys, so since there is not much activity in the markets today due to it being a bank holiday, I thought I'd run through some educational stuff for you guys to really further your learning of the Forex market so you're not just following signals blindly and wishing on a star and hoping you make money. I really want you all to get an understanding and learn this for yourself because at the end of the day, this is going to really benefit you in the next 6 to 12 months, even the years, the rest of your life. Once you've mastered this skill of trading, it's a skill you have for life that you can constantly generate money from once you get to a certain level. And the only way you're going to get to that level is by learning. So today we're going to run through candlesticks. Now you're probably thinking, what are candlesticks? You've probably seen them before on your chart and have no clue what they are. So what a candlestick is, it essentially shows price action within a specific time frame. Okay, it shows you the high of price, it shows you the low of price, it shows you the open, and it shows you the close of price within a specific time frame. So you've probably heard of the expressions 4-hour chart, 1-hour chart, daily chart. These time frames basically, what if you're analyzing the market on a daily time frame, each of these candlesticks will show a day's worth of price movement. So it will show you at the start of the day when it opens there, and where it closes at the end of the day there, and it will show you the low and it will show you the high. And this really does tell you a lot. Okay, and we're going to get into that shortly. This video might be longer than the others, but bear with me and watch this because you will learn a lot from this. So these formations here are called the bullish inside bar. So after a bearish bar, if you're wondering what bearish is, it means selling, price is falling. Bullish means price is rising. Okay, so after a bearish candlestick of price being shorted, price getting lower, we have an inside bullish bar which comes next. So after the selling bar is closed, a buying bar opens next. Okay, and this suggests a turning point in the market. Potentially after a massive sell-off, price has been falling for a while, we have this nice little inside bar which shows that price possibly might be turning. Okay, the next bar we have is the bullish engulfing bar. Now this is a very good indication that it's a strong turning point in the market, and price is really gaining some bullish momentum. Okay, so this is where the buying bar completely engulfs the previous bar, whether it's a selling bar, whether it's another buying bar. When the bar completely engulfs the whole price action of the previous bar, this is a very strong indicator that price is going to turn. Okay, and please, this, I did make this on PowerPoint over the last couple of days. It's just whipped up quickly. It's not supposed to look aesthetically pleasing. It's just supposed to give you exactly what you need and the information that you need to learn. Okay, so here's a bullish engulfing bar in a live example, okay, on a chart. So as you can see here, price has been falling. We did have a bullish engulfing here, which obviously if you did enter, you would have caught a bit of profit on this move up here. But a better example of that is, okay, so price is falling, slight pullback, continues falling. We have this candlestick here, which shows indecision, which is in the next slides to come. And then we have this huge bullish engulfing bar which completely engulfs the last candle, and then as you can see, price continues for a while and a few pullbacks here and there, but it continues its bullish momentum upwards. Okay, so the next one we have is the hammer bar. Now you're probably thinking, what is a hammer bar? Well, it's this bar here, and this shows signs of a reversal. So as price is getting lower, price is falling, and you see this bar, it shows that price is probably going to start going the opposite way and going to go up. Obviously, if price was rising and then you see this bar at the top, then price is probably going to start going down again. Obviously, it's not it's not a scientific process. It's not gospel truth that if you see one of these bars, price will do this and it will do that. Remember, trading is just a game of probabilities. There's nothing certain, but you just got to use all the confluences, all the information you have to make an educated decision. So the long wick below this candlestick suggests that price has fallen too low. Okay, where's my cursor gone? Price has fallen too low and it's become essentially too cheap, and the buyers have moved in and overrun the sellers, which has forced the price all the way back up to where it opened at. Okay, so remember, you've got the open, you've got the close, you've got the low and the high. So obviously at some point in time during this specific time frame, this bar was completely red, so price was all the way down here, and the buyers moved into the market and basically was like, this is too cheap, price needs to move up. So the buyers have overrun the sellers, pushed price up, and by the time the let's call this an hourly time frame, the hours up, the new hour bar has opened, price has been forced all the way back up to where it opened. Now this is a very, very good sign of a massive reversal coming, and as you can see, boom, 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 price is completely reversed and gone the opposite way. You've got the bearish inside bar, exactly the same as a bullish inside bar. After a bullish run, you have the bearish bar on the inside. We'll come on to this in a second. You're probably thinking that's not a bearish bar, but you'll see in a sec. But yeah, after a bullish run, you have a small little red bar suggesting that momentum to the upside has slowed and it's time for the sellers to move in and drive price down. Okay, and then you've got the bearish engulfing bar, exactly the same as the bullish engulfing bar. It's a candlestick that completely engulfs the previous bar before, okay, suggesting a reversal. This is it in action. So as you can see, we've had bullish price action. Okay, momentum is starting to slow because the bodies of these candles are getting smaller and smaller and smaller. And then you have this huge bearish engulfing bar, which completely engulfs the last couple of candlesticks. Price reverses and continues its descent down. Shooting star, okay, this is basically very, very similar to the previous candlestick we just showed when it was in a bearish formation. This basically suggests that price cannot be pushed higher. The sellers have moved in, pushed price down, and then continues its descent down. Okay, so at one point this green bar would have been, the whole of this candlestick would have been green. Basically, this could have been a resistance region, it could have been a massive key level, or it may have just been that it's just the sellers have overrun the buyers. Okay, I'm going to put this into a live example in a second and show you what you should actually be looking for, and you can't just take what the candlesticks are showing you as confirmation for a trade. You've got to have it aligned with other confluences and other reasons. Okay. So the doji, this is the bar where the candlestick is basically neither here nor there, equal wick sizes, both below and above, and the body of the candlestick's pretty thin. And this shows indecision. It can't decide whether it's going to go up or is it going to go down, okay, as you can see here. So this doesn't show whether it's going down or up, could go either way. It hasn't decided. Okay, so candlestick patterns at a support level. Like I said, you cannot just take these candlestick patterns as gospel truth, and because it's shown, a hammer bar or a shooting star or this or that, then it means it's going to do whatever it's supposed to do. No, it doesn't work like that. You've got to use it in conjunction with other things. So here, we're going to use the candlesticks in conjunction with the support region. Okay, so here we have the hammer bar. All right. And it's a very clear level of support, which is also known as a floor. Okay, price has struggled to break below this level multiple times, so suggests that it's going to bounce up and go higher. Okay, so here at this point in time here, obviously price has risen, it starts to come back down, and then you've had this huge selling bar all the way to this support region, and within, let's call this the hourly time frame, within that hour, price has started to go back up, and it's closed right at the top here, and it's shown that it really doesn't like this level. It's not going to break below it, okay? And if you would have bought there, you would have caught all this move up. If you had have held, yes, it would have come back down to here, but then as you can see, it continues shooting up. So that's another thing we can cover in another video. It's patience. Obviously, it's great when trades fly into profit straight away, and you've entered a trade, 2 minutes later it's in profit, and an hour later you're closing. Sometimes it goes into a loss, and you might be in a loss for a few hours before it reverses. A great example of that was last week on a USD JPY trade we had open, which we left open overnight actually. It was in a loss for pretty much the whole evening. A lot of you are messaging saying, this doesn't look good, should I take the loss? We held it in the morning, it reached our top profit target. So patience is a massive key to succeeding in this industry. But like I said, we can make another video on that at some point soon. So bullish inside bar and support level. Okay, so look again, like I just showed on the previous slide, this is a clear region of support. Prices struggled to break below this level multiple times. Okay, and right on the level again, you have the bullish inside bar. So after numerous selling bars, you get the green confirmation of a bullish bar, suggesting that price is going to continue its ascent. Candlestick patterns and resistance levels. So resistance is the opposite of support. It's a ceiling. Price struggles to break higher, so it falls lower. The more times it does it, the more reliable this support level is. Here we have a shooting star. So the wick of the candlestick has basically tried to break through the level, and within this specific period of time, it's struggled to break through, and price has been pushed down. And by the time this time frame is closed, the candlestick is finished right down here, suggesting that doesn't like this region. Sellers have moved in. Time to fall. Okay, so that's it for candlesticks. Very basic. Hope it made sense. And yeah, it wasn't supposed to be a all singing all dancing video. Just giving you some absolutely core features of candlesticks and the patterns and what they mean. So let me know if that makes sense, and if it does, fantastic. If it doesn't, please drop me a message and I'll try and explain it in a little bit more depth for you. But expect more videos like this today. I'm going to be covering support regions, resistance regions, trend lines, loads of stuff. So keep your eyes peeled on the group, and sorry for this video dragging on. You're probably sick of hearing my voice right now, but I'm sure it will be worth it. So thank you very much, guys.